Warren Buffett bought a house in 1958 for $31,500 in Omaha, Nebraska when he was 28 years old. Decades later, Berkshire Hathaway's chairman is worth $147 billion and still lives in the same house. Buffett has paid himself a $100,000 salary for decades and never raised it. He has not sold a single share of his own stock for personal use since 2006, and the company he runs has not paid out a dividend since 1967. He's already given away more than $60 billion to charity, and he's still sitting on $147 billion. That money did not come from his paycheck, and it did not come from cashing out winners. Everyone will tell you Buffett got rich from picking good stocks and holding them. That is the output, but the machine is something else entirely. Buffett got rich building the container that the stocks sit in, and then spent 70 years making its terms better than anything a bank, fund, or normal investor could get. Cheaper money, and money nobody can ever take back. Money the government lets him compound tax-free for a lifetime. By the end of this, you'll know the 4 moves that built the machine and the one funding source he found in 1967 that cost him less than nothing. And I mean that literally. All right, let's get into it. Phase 1, the $100 that out-earned $105,000. In May 1956, Warren Buffett started an investment partnership in Omaha with $105,100 in it. 7 partners put up the money. Buffett's own share was $100. That is not a typo. $100 next to their $105,000. 13 years later, when he shut the partnership down, those partners had done very well. Buffett had done something on a completely different scale. He walked out with roughly $25 million of personal wealth, up from under $200,000 when he started. A 125-fold jump in 13 years, on almost none of the original cash. The trick was in how he got paid. Buffett charged no management fee. He took 25% of the gains above a 6% yearly hurdle, and instead of pocketing the cut, he left it inside the partnership. His pay stayed in the pot and compounded at the same rate that the pot did. That's the first mechanism, and it's one that you can actually use. Buffett was earning via ownership rather than a wage. His slice grew from 2 directions at the same time: a piece of everyone else's gains, and then that piece compounding on top of itself the next year and the year after that. The partnership returned 29.5% a year from 1957 through 1969, with no losing year. Buffett's personal cut compounded faster than the fund itself. This is carried interest, the exact instrument that has built every private equity fortune since. The lesson underneath it is older and simpler. If you want to get rich from something that grows, get paid in a piece of the thing, not a check for your time. A check stops the day the work stops. A piece keeps compounding while you sleep. Buffett understood that at 25, but the partnership had a flaw he could not design around. The money belonged to his partners, and partners can ask for it back. So in 1969, at the top, Buffett told his partners the market had nothing left worth buying, and he closed down the whole thing. Phase 2, the dying textile mill he bought out of spite. Starting in December 1962, Buffett had been buying shares of Berkshire Hathaway, a failing New England textile maker, at $7.50 a share. Classic cheap asset arbitrage play. The company was worth more dead than alive, so the stock traded below what the pieces would fetch. Then the manager running Berkshire agreed to buy Buffett shares back at a set price, and at the last minute offered $11.25 instead of the $11.37.5 they had agreed upon, an eighth of a point. Buffett was annoyed enough that instead of selling, he bought control of the entire company in 1965 out of spite and fired the guy. He later called it a monumental mistake. He estimated that anchoring his compounding machine to a dying textile business cost him, over the following decades, somewhere in the hundreds of billions of dollars in opportunity range. But look back at what he did with the wreck. The textile business was dead, so Buffett stopped feeding it and started pulling cash out of it and pointing that cash at better things. A failing business treated as a bucket of cash to redeploy rather than a thing to fix. And when he dissolved the partnership in 1969, Buffett did not take his winnings in cash. He rolled his personal wealth into Berkshire stock and became a controlling shareholder instead of a fund manager. The swap is the second mechanism, and it's the one that actually matters the most. A fund manager runs on client money, and client money runs at the worst possible moment. When the market crashes and everything's cheap, that's exactly when frightened clients demand their money back. Buffett had just felt the edge of that with his partners. Owned company money is the opposite. Nobody can withdraw it. Permanent capital lets you buy when everyone else is being forced to sell. Buffett had traded a job for a fortress. He just just needed to arm it. Because in 1967, 2 years before he even closed the partnership, he had already bought the thing that turned the fortress into a machine. A small, boring insurance company in Omaha. The single most important purchase in this entire 70-year story. Phase 3. The $8.6 million insurer that prints free money. In March of 1967, Berkshire paid $8.6 million for National Indemnity, an ordinary Omaha insurer. To understand why this is the whole ballgame, you need to understand one thing about how insurance money moves. Customers pay premiums today. That's what you pay your insurance provider. The insurer pays out claims much later, sometimes years later. And in between, the insurer holds a giant pile of other people's money that it gets to invest. And that pile has a name, float. If the insurance company just breaks even on the actual insurance, collecting roughly as much in premiums as it eventually pays in claims, then that float is a loan at 0% that never actually comes due. And if the company is run well enough to make a small profit on the insurance itself, the math flips. The customers are paying the insurer to hold their money. That $8.6 million bought Berkshire its first real pool of float. By March 31st, 2026, that pool had grown to $177 billion. 2 decades ago, it was $46 billion. And Berkshire's insurers make money on the insurance itself. Their combined ratio in 2025 was 87.1%, meaning they paid out 87 cents for every dollar that they collected. Underwriting threw off $7.26 billion in profit for the year. Express that as a financing cost, and it is negative. Warren Buffett was handed $176.9 billion to invest and got paid $7.25 billion for the privilege of holding it. From that point on, every move Buffett made was one of two things. It either used float, buying stocks or whole companies, or it produced more float, buying more insurers. Geico, Gen Re, Allegheny, every one of them was really a purchase of more of the cheapest money on earth, especially when you're a great investor. Float is the third mechanism, and it is the one most people can use, even if they never touch insurance. Float is just money that arrives before you owe it. A gym paid in January for a full year. A software company billed up front for the annual plan. A contractor taking a deposit before the work starts. Any business where cash comes in before the cost goes out is sitting on float, and most operators leave it idle instead of putting it to work. In 1972, on the urging of his partner Charlie Munger, Berkshire paid $25 million for See's Candy, a California chocolate maker with a brand loyal enough that customers kept buying every time the price went up. No losses in volume, just more margin on the same box of chocolate. See's needed almost no new money to keep running, and it threw off more than $2 billion in cumulative profits over the following decades. Buffett took that $25 million candy company and used its cash plus the float to buy stocks during the worst markets of the 1970s. This is where the folksy stock picker story and the real story finally separate. In a paper called Buffett's Alpha, 3 AQR researchers took apart Berkshire's entire record and found the returns were not magic. He ran leverage of about 1.7 to 1, funded largely by that cheap float applied to safe, high-quality, sensibly priced stocks. A hedge fund runs the same kind of leverage borrowed from a broker and gets a margin call at the bottom. Buffett borrowed from his own policyholders at a cost below zero, and no one could ever call that loan. The performance is a reward for cheap, safe, quality leverage. Every single dollar put into Berkshire in October 1976 was worth more than $3,685 by early 2017. The stock picking was real. The financing is what made it historic. Put the whole run in one line. From 1964, the year Buffett took control, through 2024, Berkshire compounded at 19.9% a year against 10.4% for the S&P 500. Double the rate, sustained for 6 decades. A Class A share traded around $19 when he took over. By the end of 2025, it was worth more than $750,000. So now Buffett had a money printer bolted to a fortress that nobody could raid. All he needed were moments when the rest of the world was too scared to move, and he waited 30 years for the absolute best of them. Phase 4, why everyone else had to sell in 2008 and he got to buy. In September and October of 2008, the credit markets froze. Lehman was gone, money market funds were breaking the buck, the financial system was 48 hours from something nobody had a name for yet. Almost every professional investor on earth became a forced seller that autumn. Clients panicked and pulled their money, lenders demanded repayment, and good assets went at terrible prices because capital was running out the door and nobody could get it, and nobody wanted to invest in these companies. Buffett had spent 40 years making sure he would never be that person. Berkshire had no clients who could withdraw, no dividend draining it since 1967, a controlling shareholder who could not be outvoted, and it was sitting on float and cash while everyone else was sitting on margin calls. So while the smartest people in finance were selling, Buffett was the one person in the world with a fortress full of dry powder and permission to spend it. Phase 5. The $5 billion checks nobody else could write. He wrote a $5 billion check to Goldman Sachs for preferred stock paying 10%, with warrants to buy Goldman shares at a crushed price attached on top. He did a similar $3 billion deal with General Electric. In 2011, he ran the same play on Bank of America, $5 billion at 6% with warrants on 700 million shares at $7 each. And when he exercised those Bank of America warrants in 2017, the paper gain was more than $12 billion. Goldman alone eventually returned $5.6 billion on that $5 billion check in roughly 2 years. Most hedge funds do not post that across an entire decade. If you want to build a habit of watching how operators actually structure their businesses and their money, hit subscribe, because we have a new breakdown every single week. No other private actor on the planet could write those checks in that panic, and the terms reflected it. The interest was almost the small part. He was being paid a premium for being the only buyer left standing, and for the signal his name sent that the system itself would survive. There's a great Buffett line that I love, which is, you only find out who's swimming naked when the tide comes out. And oftentimes, Buffett's best deals came when the tide came out. This is what permanent capital actually buys you. When your money cannot be taken away from you, you get to wait for the exact moment everyone else is being forced to sell, and then move in while good assets are cheap. Patience only works as a strategy when nobody else can force you off it. Go back to that fund manager with identical stock picks. In 2008, he was selling the same bargains Buffett was buying at the same prices because his investors were pulling out. Same skill, same market, opposite outcome, decided entirely by whose money it was and whether it could run or not. Permanence does not just beat a panic. The one man Charlie Munger called a better pure allocator than Buffett was Henry Singleton, who ran a conglomerate called Teledyne and matched Berkshire's returns for years. But Singleton never welded the door shut. When he left, Teledyne was broken up and sold off for pieces. Buffett built the same returns and then made the machine impossible to dismantle. Buffett's name did more than write checks too. Sellers of great family businesses called Omaha directly, skipping the bankers because selling to Buffett meant permanence and a handshake instead of an auction. But the sharpest loop in this whole machine never makes it onto a mug, and it's the reason Buffett can go on television and argue that rich people should pay more in tax, while he himself legally pays almost none. Phase 6. The tax trick hiding inside the grandpa image. Warren Buffett has never taken a dividend from his Berkshire stock because Berkshire has not paid one since 1967. He has never sold shares for himself, and when he gives away money, he does not sell stock and donate cash. He donates the appreciated shares directly. Line those three facts up and you get the fourth mechanism, the quietest and maybe the most valuable of all. Buffett has legally avoided tax on nearly all of his 6 decades of gains, which is incredible. No dividend means his stake produces no taxable income from year to year. Never selling means the enormous gains inside those shares were never realized, so they were never taxed. Donating the shares themselves instead of the cash wipes out the built-in tax on them entirely. The more than $60 billion he's given out since 2006 carried out decades of untaxed gains with it. A tax you defer is an interest-free loan from the government that compounds right alongside your money. Every dollar Buffett did not pay stayed in the machine and kept working across 60 years compounded. Now, the honest part, because this audience checks, this is not simple hypocrisy. Buffett argues the wealthy should pay more while playing strictly by the rules that exist, and the corporation he built is one of America's largest taxpayers in history. Berkshire paid $26.8 billion in federal income tax in 2024 alone, about 5% of everything corporate America paid that year. Its aggregate federal tax bill since 1965 is north of $101 billion. The structure does not dodge tax so much as move it. It shifts the bill off the personal layer, where Buffett would owe it, onto the corporate layer, where the compounding happens tax-free in between. The last piece of the seal is control. When Buffett created a second class of Berkshire shares, he built a voting gap on purpose. Each Class A share carries 1 vote. Each Class B share carries 1/10,000th of a vote. Buffett keeps his wealth in the A shares and gives away the B shares, which lets him hand out more than $60 billion of value while still holding 30.2% of the vote on just just 13.7% of the company. He separated giving his money away from giving his control away and kept the control. That structure also means whoever runs Berkshire after him cannot be pressured by activists to break it apart. The votes are locked by design for as long as he holds them. Which brings us to the number that ends the story, and the one thing even Buffett admits the machine cannot beat. Phase 7, the $397 billion problem. Here's the part that most business channels skip because it complicates the legend. One of the most profitable single investments in the history of investing is Buffett's Apple stake. Berkshire started buying Apple around 2016 for roughly $31 billion. In 2023, the position was worth more than $170 billion. Then Buffett did the thing folksy long-term investors are not supposed to do. He sold about 2/3 of it during 2024, and he parked the proceeds in treasury bills. That selling, plus years of finding nothing big enough to buy, built a cash pile that is now almost hard to describe. Berkshire held $397.5 billion in cash and treasury bills at the end of the first quarter of 2026, larger than the annual economic output of entire countries, earning roughly $12 billion a year in interest. And now the honest scoreboard, because the machine finally met the one enemy it cannot outstructure: size. Berkshire is now so enormous, it has slowly converged towards the very market it used to crush. The stock rose about 10% in 2025 and trailed the S&P 500. A plain index fund, the thing Buffett tells ordinary people to buy, beat him. In his final shareholder letter in November 2025, Buffett said it himself: many companies will do better than Berkshire over the coming decades because size takes its toll. On December 31st, 2025, about 70 years into building the machine, Buffett stepped down as CEO and handed over the controls to Greg Abel. He kept the chairmanship and he kept his votes. He is still 95 years old and he is still, by choice, giving the whole thing away. And yes, Warren Buffett, at 95, still tap dances to work. Buffett has said publicly that a child born to a wealthy family did nothing to deserve that advantage, and a child born poor did nothing to deserve that either. He calls the accident of his birth in the right country, the right decade, with the right mind for numbers, the ovarian lottery. The machine was always going to go to someone else. He just spent 70 years building it first. Now, go back to that $100. In 1956, Warren Buffett's own money in his first partnership was $100. 70 years later, that $100 is a fortune of around $147 billion, and he's donating almost all of it. Now, take a second $100. A stranger who put that into Berkshire in 1965 and never touched it again, yeah, they would have $6.1 million by the end of 2025. The same $100 in an S&P index fund would be worth $45,000. Same machine, same 60 years. So the play, stripped of Omaha and the cherry Coke, get paid in a piece that compounds, not a check that stops. And never let anyone put you in a position where they can pull it back. And plug the 3 leaks that drain everyone else: the fees, the forced selling, and the tax, so that almost everything you make stays inside the machine and keeps working. This has been the Warren Buffett Portfolio Breakdown. I'm Buster. See you next time.